This is frankly the most diverse panel I've seen maybe ever, because we do have an investor, a regulator, and 2 securities lawyers. So it should be an exciting one. Let me introduce you to everyone very quickly, and then I'm going to ask a couple of questions of the audience. Immediately to my left is Peter Harris. He is a partner with the University Growth Fund, the largest student-run venture fund in the country. His investments span early growth and late-stage companies across a broad range of sectors. I did ask everybody for a fun fact about themselves so we could know them a little more personally, and Peter's is he has a soft spot for hardware startups and has been an addict of Kickstarter since they launched. He is a proud early backer of some amazing companies, including Pebble and SmartThings. So Peter Harris. Next, we have Marty Tate. Marty is a local Salt Lake securities lawyer and a partner at Carmen, Tate, Lehnof, and Israelsen. His first crowdfunding client was 7 years ago, before the Jobs Act, with a peer-to-peer payday lender. He spent 8 years managing a private investment company before going back into practicing law. And his fun fact is he played bass guitar in a band throughout college and was on the fence between law school and going on tour. Next, we have Doug Ellenoff. Doug has been involved with the crowdfunding since 2011 and worked with the SEC and FINRA on the Jobs Act rules. He's a securities lawyer from New York City, and he was a top 50 squash player. Lastly, you guys didn't sit in my order. Lastly, we have Keith Woodwell. He has been the director of the Utah's Division of Securities since 2008, and they are the state agency responsible for licensing and regulating broker-dealers and investment advisors. He's a local guy, graduated from BYU Law School, and after leaving private practice, he worked for 4 years as Associate General Counsel to the Utah State Legislature. Now, I have to say, Keith has maybe the most interesting fact that I've ever come across, and when I read it, I was thrilled to be able to say it. After the attacks on September 11th, 2001, Keith took a 6-year career detour to work in Washington, D.C. and overseas in the National Clandestine Service of the CIA. Right?
That's why I'm here, to spy on everyone.
Right. All right.
Yeah.
Yeah, that's right. So I have a couple, before we start, I do have a couple of questions for the audience, just because I want to kind of gauge what you're going to be most interested in. How many people here have ever invested in a crowdfunding campaign, be it Title II, be it Kickstarter, anything like that? Do we have any investors in the crowd? And how many of you are mostly interested in finding out about Title III from an investor standpoint? Okay, and then how many of you are companies, work with companies, or are entrepreneurs who are trying to find ways to get funding? Okay. Oh, the other thing that we're doing for this, you can see it up here. So I'm going to ask a few initial questions, then we'll open it up. We think we're going to have a lot of audience questions. We can do it one of 2 ways. We can raise your hand and someone will bring you a microphone, but we also have a Twitter question. So if you hashtag UTCF, Utah Crowdfunding 2016, we can get your questions through Twitter. I felt like I couldn't multitask that much, so I will be getting them texted to me, so do not be concerned that I'm actually doing an email and reading my phone. I'm actually just looking at the questions that are coming in so I can ask them. So let's just start and talk a little bit about Title III, the changes that are coming, and what that means for everyone. So, Marty.
Oh, yes.
Can you explain the changes that will occur between what's happening today and what's happening on May 16th when Title III goes live?
Yeah, I'm happy to. So I think Todd did a really good job explaining sort of where we are currently, which is, as Doug and many can attest, we've already come a tremendous. We've come very, very far from where we were 4 years ago when the Jobs Act was passed. We took the first step, which was Title II, 506C, which removed the ban on general solicitation, and that's been going for a couple of years now. You've seen success there. You've seen a lot of movement there. Just last June, Regulation A+, that part of the Jobs Act, Title IV, went into effect. You've seen tremendous momentum there. Sort of the final piece of this puzzle, which is the one that most everybody thinks of when they think of crowdfunding, or when you mention that, is Title III or Regulation CF. We were in Las Vegas at the last conference. We said we need to stop calling it Title III because that's in the past. It's Regulation CF 4A6, which will allow, so on May 16th, issuers will be able to go online and sell securities through a crowdfunding campaign to anybody, accredited investors, non-accredited investors. These are U.S. companies. And the only, there are restrictions and limits on that, but those issuers that are seeking to raise capital from the crowd can do that. They have to do that through a licensed, a registered broker-dealer, or through a approved, FINRA, SEC-approved funding portal or licensed intermediary. And so that's the big change. That's something that Doug has been in Washington, D.C. hundreds of times, moving that bill forward and getting us to where we are now. That will allow an issuer to sell securities through one of these portals or through a broker-dealer up to $1 million within a 12-month period on a rolling basis.
Okay, great. So now, Peter, when you hear this as an investor and you hear about this new opportunity, what do you feel that opportunities are created by these changes, and what are the potential risks and benefits to investors?
Yeah, so that's a good question. Generally, I've gone through some of the wording on this new legislation that's coming down, and generally, I think that what you're going to end up seeing is it places a tremendous amount of burden on the company, right? The company now has to have audited financials. It has to have a bunch of different things. They also are going to run up against issues with, only having 500 investors in the company, right, as a private company. And so it creates a lot of these things. And I think when the idea first came out, the idea was like, look, right now, as an individual, if you're not an accredited investor, you don't have access to arguably like this really interesting, really exciting, potentially highly profitable, although also very risky asset class, which is venture investing and growth investing. And so, look, how can we provide access to that to your average investor, but also how can we help launch more companies? I think from a venture capital perspective, there was a lot of conversations that maybe VCs would be really threatened by this. Ultimately, I don't think that that's going to be the case. I think that your top tier, best entrepreneurs that have venture backable businesses are going to go to venture capitalists to raise that money. It's faster, it's easier. They don't have to deal with as many shareholders. They get very specific advice and help. There's a lot of signaling that comes with that. The flip side of that is I do think it does open up the opportunity for companies that maybe aren't venture backable, right? So I'll give you a good example of that. My uncle runs a hearing aid business, very successful hearing aid business. Could $1 million of additional capital be really meaningful to him and help him grow and expand and do meaningful things? Yeah, absolutely. But as a venture capitalist, am I going to invest in that business? Probably not, because it's not the type of investing that we do. It doesn't have the potential to grow and be as big and scalable and so forth.
So let me just follow up that question. So you spoke from your perspective as a venture capitalist. What about your perspective as an individual investor that loves early stage, that loves technology, that loves Kickstarter?
So, as an individual, so the good side, right, is if there is a really hot company and it is really cool, like now I would have the opportunity to invest. My concern is that what you'll see is the companies that couldn't raise it from venture capitalists will ultimately raise it from these sources, and those won't be very attractive deals at the end of the day. And that presents a tremendous amount of risk for kind of the retail investor. And so, if you're sitting out in the crowd and you're thinking, wow, this new change is going to open up kind of this world of opportunities for you, I would be very hesitant because I think there's a tremendous amount of risk.
Okay. So, Doug, Peter talked a little bit about how hard it was going to be for the companies to raise money. Can you tell us a little bit about Title III and specifically what a company has to go through to raise money using Regulation CF?
Sure. Just to clarify one thing, Peter's right that in the original proposed rules there would be an audit requirement, but in the final rules that actually got eliminated, which is a good thing for the entrepreneurs in the room. The first thing is you have to think long and hard, as Peter is saying, given that perspective, as to whether or not you want to accept money from people in theory, and I think this is pretty theoretical, that you don't know. I think for the vast majority of entrepreneurs, this is not competitive with venture capital. It's going to be friends and family finance done online, so it's going to be people that you know from your history. The benefit of doing it online and with some limited forms of social media, heavily curtailed, as Marty points out, it's not like a Title II campaign where you can say whatever you want. There are a very limited number of things that you can say in a Title III campaign about who you are, what you're raising, and then you direct everybody to a portal, and the rest of the transaction or communication is housed in that platform. But I think it's going to be friends and family. I think it's going to be a limited number of people for most campaigns, and in the rare case, like an Oculus, that it'll go viral. And the example I'd give to counter Peter's initial sentiment is Oculus went to Silicon Valley and asked for money and got turned down, as did Pebble Watch, had very successful campaigns, and based upon using crowdfunding, as in Kickstarter crowdfunding, as a focus group, then the VCs learned that it was an acceptable product to people, and they ultimately financed those opportunities. So there are several examples, good examples, where crowdfunding actually is going to be made available to retail investors through Title III, that the smart money chose not to put money in, whether it was too early or not. And so I think there are going to be opportunities for investors and entrepreneurs. That doesn't mean it's not risky. People will lose money. I think a lot of the investment that goes into Title III will be like Peter's, was it your uncle, that has a hearing aid business, but it's going to be debt financing. It won't even be equity financing. And you'll just get a current return, and it's self-liquidating. You don't have to worry about whether or not the company goes public, which it probably won't. But to get ready, so you have to think long and hard about all those things and whether or not you really want to deal with a lot of people. You also have now the pressure. It's a securities transaction, as you will hear. This is not just fun and games like Kickstarter, even though the people who don't do Kickstarter well have learned that there's a lot of pressure if you don't deliver the products on time the way you said you were going to. Title III is a securities transaction. You have federal and state regulators looking at the activity to make sure you did it responsibly. And you need to now learn a whole new language about how to run your business and to communicate in a way that's responsible and is in compliance with the state and federal securities laws. So Marty will help guide you through what you can and cannot say and keep yourself out of trouble. So that's number one. Number two, quickly, you got to pick your portal. Picking your portal is very important to decide where you're going to put your campaign up on, because not all funding platforms are going to be the same. You have broker-dealer platforms, you have just funding platforms, and they play different roles in the ecosystem, and I won't go into detail right now. Then you have platforms that are vertical for consumer products. You have other ones that are going to be geographic in nature, so pick wisely, make sure they're responsible people. Check to see if they have any regulatory background, which they presumably shouldn't, because they wouldn't be approved to be portals. But if they're a fake portal, you want to figure that out quickly. Next, you have to provide disclosure. One thing that's lost by most people who don't pay attention to what the rules are here, you don't just get to post your deal like on Kickstarter. You have to provide securities disclosure to investors so they can make an informed decision as to what the investment is and what the risks are, what the cap table is, and you have to have reviewed financial statements. I actually have created, if I can do a little self-promotion here,
Please do.
a legal tech application to bring down the cost of providing this disclosure. It's called iDisclose. Go check it out, idisclose.com. And we have a Form C do-it-yourself tool like TurboTax for disclosure. Ultimately, it has to be reviewed by people like Marty to make sure it's actually compliant, but that's to bring the cost down and to make sure you're compliant. And so those are the things that you have to do to prepare in order to get a Title III crowdfunding campaign done, and not just done, but done responsibly and compliantly.
Okay, so Keith, what are the things that the state regulators, now that we're on the eve of this, are going to be looking for, going to be checking, going to be concerned about?
Yeah, so I think it's been an interesting conversation that regulators have had in relationship to equity crowdfunding, because at first, when this was contemplated in the Jobs Act, I think the warning that regulators were trying to throw out was the fraud risk, that you're going to invite con men to come out there and claim that they're doing cold fusion in the basement or whatever, and then offer a slice of the action to everyone through some crowdfunding portal. And realistically, I don't think that's the risk here. If you're a fraudster, which is what my office deals with all the time, you're just going to go out and solicit friends and family and church members and whoever else, and you're not going to bother to jump through the hoops of using a funding portal and meeting the requirements of Regulation CF. That's just not how you're going to do it. If you're going to break the law, you're going to break the law, and you're not going to just do it halfway. So I don't really think it's fraud risk, but there is a fundamental policy issue, which now the Congress and the SEC has decided that we are going to allow this. I'll admit that personally I'm a bit of a skeptic about how well this is going to work. And the reason for that, fundamentally in my mind, is you're now opening up a system where you're allowing the least sophisticated type of investors, these are unaccredited investors who don't have any particular sophistication or expertise, and by definition don't have the money to lose in a risky venture, and you're exposing them to the most risky type of investing, which is this early stage investing. So there's a lot of precaution that needs to take place here. Now, I think it could be, in the end, very successful, but I'm hoping that people will go in with their eyes open, because there's certainly risks on both sides of the equation, both for the entrepreneur and for the small investor who's looking to get into one of these deals. On the issuer side, the company that's actually trying to raise the money, they have to consider whether or not this type of fundraising is right for you. Do you want to have 100 small owners of your company who may be calling you and saying, hey, well, how's this deal going, or how is that contract working out, who now own a piece of your business and want updates and want to know how things are going? And that's something you've got to think about and consider. And it also could potentially, and some of the other panelists can address this maybe better than me, but it may limit the source of funding in the future if you grow even more. Is a VC firm now going to be interested in you if they got 100 small investors to deal with that they may have to buy out? Or you might even be diluted in the next round of fundraising in this process. And then on the side of the investors, it's not so much the fraud risk, but it's understanding that you're locking up your money for a long period of time. By definition, these are not liquid investments. Under the regulation, it's 12 months at a minimum before you can resell this, and there's no guarantee that there will even be a market to resell these securities. You've got to understand that the risks of disclosure here are significant, because yes, there are disclosures that are required, but if this is an early stage kind of idea stage company, how much can really be disclosed? There aren't revenue streams to talk about yet. It's a concept. And whether or not this concept's going to work and generate revenue and eventually profits is an open question. So there's just a lot to consider, I think, on both sides of the equation. Now, on the positive side, I will say I'm very glad that the SEC finally put out the rules here and opened the door so that we can have federal level crowdfunding, because there's a variety, many of you maybe are familiar, maybe not, but a lot of states have passed their own intrastate crowdfunding laws. I think we're up to about 30 of the 50 states that have passed their own laws now, but they're all over the map. It's not consistent, and you've got intrastate limitations where the issuer and all the investors have to be located in the same state. And if you're going to do this over the internet or through social media, it kind of defeats the purpose if you're limited to just your geographic area. So I'm glad that the feds have stepped in, that they've kind of preempted the states on this issue and said there's going to be one set of rules. This is how we're going to do it. Rightly or wrongly, they've put the roadmap out there for everyone to follow. And I was talking to Marty earlier, we'll see. 2 years from now, then we'll have a better idea. Is there going to be demand for this? Is there not going to be demand for this? Well, we'll find out.
And just to follow up on that, Keith, is Utah one of the states that has their own regulations?
We do not. There's been a couple of proposals, and I'll take the blame for that. I'll freely admit I've been up at the legislature lobbying against some of those. And a lot of the reason for that, my argument was, look, let's wait and see. There is a federal regulation in place. It's coming. It makes more sense for this to be done on one model on the federal level where you can raise money across all 50 states. And there's arguments as to whether or not the feds got it right about what the limitations are, but let's give it some time and see if it works. And if it doesn't work and we think that's a failed model, all right, well then maybe we need to come back and look on the state level and see if we want to do something different here. But I think we should at least give it a chance to work first.
Okay, so let's talk a minute, even though most of the people here seem like that they're entrepreneurs looking to raise money, several of you have brought up the investor protection side of this. So maybe we should take a minute out to talk about that and what that looks like, how that might work. Marty, can you talk a little bit about the rules and the things that are or are not in place to protect investors?
So there's the Regulation CF basically, I think, puts in place, a few levels of protection. The first level is there is a responsibility on behalf of the broker-dealer or the funding portal to there is a responsibility there to provide, to help protect investors through a couple of ways. One is they have responsibility to vet out the issuers. They have to do some background checks on the principals. They have to do bad actor checks. They have to look into the issuers themselves. The second piece that they have to do is they have to provide educational materials and provide take the investors through a process so that people that are going on to make an investment in these companies understand what they're doing. They understand the risks of investing. They understand the risks of buying a security, what it is. As Keith mentioned, this is an illiquid security. There's not going to be a market for it. So they understand, hey, I'm buying this and I'm holding until the company sells or until there's a public offering or some other liquidity event. So there's that level of protection. And the issuers themselves obviously have to provide disclosures, as Doug mentioned. They have to file a Form C. They have to provide certain disclosures which say, here are the risks involved with investing in our company, and let the investors understand that, in addition to the risks that I mentioned, that, hey, we might be a new company. This is a really competitive market. Typical disclosures you'd see in other securities offerings. So there's that level of protection. And then, although the issuer is not being, the Form C is not being reviewed or approved by any regulatory body, I guarantee they will be looked at. So you will have regulatory authorities, although they're not approving, they're going to be looking at these, especially at the beginning, and understanding who's issuing these securities and making these offerings. And I'm sure everybody in the room understands, but just to be clear, as compared to what we were talking about this morning, which was all perk-based or donor-based, these Kickstart campaigns, in this case we're talking about making an investment in a company. You don't get a watch or you don't get a T-shirt. You get an equity interest or a debt interest in this company, which it's not tangible. You don't get to say, hey, well, when the product comes out, I get one. No, you become an owner in this company, and that might mean you're an owner until it, for the rest of your life. It might mean that you're an owner until it fails or until it goes liquid. So those are the risks and things to consider in making those investments.
Okay, and just sticking with the investor side for a second, Doug. With Title III, I hear a lot crowdfunding for all. Everybody can invest. to Keith's point, some unaccredited investors might not have the money to lose, I think is exactly what you said. Is it in fact a situation where, anybody can invest as much as they have, or is there anything to prevent that from happening, or is there any sort of investor protection going on?
Well, there's a financial limitation, which is any American invest up to $2,000, and then its income or net worth ratcheted up from there. So up to $100,000 after $60,000. $60,000, I say, because it's actually it's $40,000 is 5% of $40,000 is the $2,000. After that amount, up to $100,000, you can do 5%, and above $100,000, it's 10%. So that's the financial limitation per deal and a $100,000 cap in a 12-month rolling period. So that's one limitation. The thing I want to emphasize about what Marty said, because I don't think you can find it in another securities law program, because we as an industry are very concerned about what Keith's pointing out, about investors understanding about why statistically they're more likely than not to lose their money, is this statute requires education. That doesn't show up anyplace else in private placement activity. It's incredibly responsible, and if the funding platforms do it properly, which is embedded in the statute and required by FINRA to look at before these platforms go live, the education should be robust. It'll be general in nature about crowdfunding and private placements and the illiquidity of the market and no secondary trading, as well as statistically these things are more likely than not likely to work out, and you're going to lose your money. But what is failed to be realized by most people is that friends and family investing in this country goes on every single day, offline, less responsibly than what we're talking about, much larger than VC and angel investing combined, which is about 20 billion each. So what I like about it is we're doing it more responsibly online with education and through centralized funding platforms. So I think that's incredibly investor protective. It's not going to stop failure, but that's what investing is about. That's what happens offline. And so I'm comfortable that there will be failure. It's not just fraud, and I think Keith's orientation is 100% correct. And in Title II crowdfunding, which has been around for over 2 years, and there's been, numbers vary, over $1 billion of funded finance opportunities already. There's been one recognized instance of fraud, which actually is a positive fraud if there can be such a thing, and now I'll try and convince you. An entity raised $6 million online, and in less than, I think, 2 months, the regulators were on top of that opportunity because of the transparency, and the regulators could see through the social media that the individuals who promoted that deal were spending the money on their own stuff, and they recovered over 50% of the money, which I think is fair to say you wouldn't typically find in a fraud.
That's right.
Which is incredible. So it's a statement of the power of the crowd as well as transparency. So that's investor protective. But it won't stop people from losing money. But I think people know that when they're investing with friends and family and they want to support them in their individual entrepreneurial opportunities, they're willing to take that risk as long as you don't abuse the public trust by misusing the proceeds, which is the single biggest problem I see or foresee.
Okay, so I'm very excited to say that we are starting to get some questions, and I'm starting to get some Twitter questions because this was basically an experiment, so thank you for that. We have a question right here. He'll bring you a mic.
Got a mic coming for you?
I've been a business consultant now for 60 years. I haven't used a lot of security attorneys here, but once in a while, and I could only find 3 that really were licensed in the sense that they had insurance, malpractice insurance in the field. If they practice only, 30%, I don't know, you'd better know than I, then they could, their insurance, although it wasn't covering strictly insurance for fraud involving securities, that their practice then with that insurance, general insurance, would cover it. However, I think you're in for a real ride because, number one, the average attorney doesn't know anything about securities and is ill-advised to give advice, but yet they'll see this as a way to practice. You'll go to your local attorney, you'll think that he knows something about security, and he's going to get you into this thing, and you're going to find that the white-collar people are going on your back all the time, and these lawsuits are just going to be brewing everywhere. Secondly, if you have to be a security salesman, you have to be a financial consultant, and you're using that license to sell stock, you're going to be restricted by your company. You're not going to be able to offer these things right now because the company that you work for, you know, like whatever financial institution you might be investment, they're not going to allow it because they don't want these lawsuits, and they're liable to lose their license even doing something like this. There is so much that you're putting on the table here that you've created that have no answers. And all it does, so far as I've heard, is create a gold mine for litigators. Because you're hiring, there are going to be lots of litigators. People who, you know, for one thing, just going through and creating the risks that you're talking about and getting it into a document. You're not going to do that by yourself unless you're crazy. You're going to have to go through a securities attorney that knows how to list those risk factors. And so also there's tremendous problems as far as perceptions. Even if you go to your family and friends and you offer them your dialogue with them and on down the line when things go awry, which they will, those family and friends are going to be on your back for making you or enticing you into something like this. I could go on and on about this, but I don't want to because I have a legal background too. But I'll tell you, it's a huge mistake, in my opinion, to come up with something like this. If you want to have a law,
So I'm just going to jump.
that allow sophisticated investors.
I just
And
need
then
to
you
jump.
should,
I'm just going to have to cut you. I'm sorry. Do you have a question on that?
I'll
for the
jump in.
panel?
So just to your point and backing what Doug said, this is some friends and family. People are raising money from friends and family. They've been doing it forever, and a lot of those same issues exist. I think this is a better system because now, as Doug said, you have to go through a process. I mean, we all know of people that invested with their neighbor or their cousin or a guy in their church, and it didn't go well. Here, there's a process they have to go through. There's specific disclosures. Hopefully, like you're right, they will work with competent securities counsel that can help them with that. But there's the educational piece. So I think it's an improvement on the current process. And I'll let Keith.
Please.
Yeah, I mean, there's a lot there, but I'll address maybe two aspects of that. One on getting a competent securities attorney. That's certainly true, and this is a specialized area of law. And we run into that problem a lot where somebody's gotten advice from an attorney, but it's not somebody who knows securities, and they've gotten bad advice. And they end up running afoul of the law. The good thing here, I think, is you are required to go through a funding portal. And so these are registered portals, and I'll say my criticism, a lot of the state interstate crowdfunding laws, a lot of them don't require a portal. And so it's kind of do it yourself, and people are going to get themselves in a lot of trouble. For the entrepreneurs in the room, when you enter into this arena where you're talking about equity crowdfunding, not pre-sales of product or giving away T-shirts or other prizes, you've entered the securities realm, and it's a very regulated field. And it's not buyer beware, it's a seller beware area. The risks are on the seller. You have to disclose. You have a positive obligation to disclose all of the relevant risk factors. If you don't disclose all of the material information, you've committed fraud. You can't hide anything. So that's why you need a good attorney who knows this area, can walk you through that process, help you make the right disclosures. But to be honest, I think it's going to work much better here because, in theory at least, the portals are going to reject the deals where those disclosures haven't been made. They're going to have their own in-house compliance people making sure that those burdens have been met.
Great. Let me ask a question from Twitter. How is this different than penny stock investments, and are they not just as risky for the investor? To anybody on the panel?
I think it's a great question, and I think it goes to the emotion in the last question, is these are not securities that are being sold. There are not, if you're talking funding platform as opposed to broker-dealer, which is a completely different animal, and obviously heavily regulated. A funding platform is an agnostic platform. You have people who are posting entrepreneurial opportunities. Investors only come to this platform after this limited notification that it exists if they want to. You don't have somebody picking up the phone and saying, you need to go to the platform because I'm going to get a commission. It's not going to happen. You either go there because you choose to go there, and once you go there, you have to go through an onboarding process to describe who you are and what you're interested in. You have to go through the education process, and after all of that, you get to invest, if you choose to, those small increments, as opposed to friends and family and barbecue talk, where I can tell you one thing, I can tell the next person something completely different. And that's the difference, is they're not registered reps hawking the securities.
Okay. Do we have any audience?
We have a question right here.
Yeah, a couple of quick questions. Number one, I don't know, Doug or any of you, do you have any idea what the cost might be for an entrepreneur in doing something like this? Is we're talking $1,000, $10,000? The other question is, do you have any ideas on the return for an investor? If they invest $1,000, will they get 10% back, 50%? How much equity? Any ideas on that kind of
Well,
stuff?
Keith's probably going to guarantee a return for you, but you know, in the SEC rules, it talks about what they think the cost of the capital for the raise will be, and it varies. The best thing I can tell you is it's going to vary by region, and it's going to come down dramatically over time as the technology solutions against this new world are building out the ecosystem like I disclose. I'll ask Marty a question, not about himself. What do you think the general cost of doing a disclosure document would be that you've seen historically in a 506B context?
So, and again, that's going to vary by region, right?
Okay.
And that's going to vary on the type of the deal. But I would suspect, you know, I mean, you're going to be 15,000
On the low end.
On the low end to 30,000. I think on a, and as Doug said, I think over time that the price will come down. But I think you're going to see out of the gates, it's going to be something less than that to file your Form C. And I think especially as attorneys embrace technology and start using solutions, I think that price will come down.
So
considerably.
Form C is Form C on iDisclose is $2,500. Plus, we'll introduce you to lawyers who will do it because they're comfortable with the system. I don't know if Marty has a pricing model, but that statement alone, I couldn't have given you 2 or 3 years ago. And accountants, we work when we're going around the country. There are accountants who are coming up with fixed, flat fee numbers in order to accommodate for this new community. And there's a lot of pressure to deliver the services in a way that you entrepreneurs are going to keep more of that money.
Let me just say, though, not to talk about my own company, but it's more than just the legal docs. There's a variety of things that go into it. So there's the legal, there's the accounting, there's the technology. So there's a lot of things that go into it. We are estimating at this point on May 16th that an entrepreneur can get everything done for sub $10,000. And you know, just in full disclosure, I partner with these guys on several things. So, you know, we use Doug's iDisclose. We use some of these things. And so, to their point, the more technology can be involved, the less that you need someone actually, you know, hand doing things, the price is going to come down. But just as a ballpark, when you're thinking, hey, I want to raise $40,000, maybe this is not the right way. If you want to raise $150,000, maybe that's a different animal. So just as a guideline, around $10,000.
And then I can speak a little bit to the returns. And the honest truth is that we're going to be really hard to know. And the likely outcome, like has been discussed on the panel, is that these companies are most likely going to go out of business, right? So you're going to get zero. A great story around that is, so there's this really storied investor, Ron Conway, he runs a fund called SB Angel. I think he made over 50 angel investments. I think almost all of them went to zero. And the only thing that ended up saving his fund was his investment in Google, right? So, if you're thinking, well, I got to make, 50 some odd investments in very good companies, right, in order to generate a return, right, that's something you need to be thinking about, because on the individual basis, you're going to have a really hard time. And if you look at most seed funds, that's kind of how they're structured, is a bit of a spray and pray.
And I want to jump in and intercede. A lot of it, too, will depend on how the deal is structured, right? So as Doug mentioned, you might, for example, the hearing aid company, that would be a great model for debt, right? They would be, and in that you can actually get your head around what my return might be. I'm borrowing, I'm lending this money out at 8%. I know I'm going to get an 8%. If they pay, I'll get an 8% return. And going to something that was said earlier about the market, who is the ideal candidate for this? It really does feel sort of that friends and family round. I think the companies that are going to have success with this are people. It'll be a local company that people there's already that sort of patronage. It will be a company with, to quote one of our colleagues, that has a shiny toy that people can see and go, oh, yeah, I like that. I want to invest in that because that's something really cool. Or it's going to be a company that already has a community based around it. I represent a platform that's doing, that will feature video games and gamers, and there's a community built in there. People are going to not only want to, and that's something that's not built for like a Kickstarter. You can't, hey, invest in this and you might get a hat or something. These people can actually invest in this game and get a percentage of the company that's launching it. So I think those are the candidates that are at work. But again, the returns on that will depend upon how it's structured and
Can I just say one thing slightly differently?
One thing.
One more thing, sorry. Unlike the angel analogy, which I think is the way the VC model works, is that you want one deal that's going to really make your returns. Because there are going to be so many debt financings in, I think, Title III, the beta or the risk profile, even though most people say it's a riskier asset class because small is therefore riskier, I think because many financings, like the hearing aid example, or the restaurant chain that needs to raise $500,000 to open up another restaurant, I actually think it's less risky. It's going to be debt financed, just like real estate. Real estate returns in Title II crowdfunding actually have been pretty darn good. They've been in the 6 to 8% return over the last couple of years. So I think the risk profile is less if it's debt financing and it's an established business versus a tech startup, even though the returns overall will definitely be less than the venture model.
Okay, we have a question over here.
Okay, so we have an investor who finds a properly accredited platform, lists their opportunity, does a very comprehensive, full and fair disclosure, gets it reviewed by the best houses in town. Are investments then insured by the nearest plaintiff's attorney? Is there any safe harbor in this process that says that the unsuitable investor can't come back?
So there's no guarantees on that side either. The whole point of picking what you call a qualified attorney is to build the best insurance profile, using insurance broadly speaking, so that you don't have a problem. That's the responsible thing, to limit the mistakes, because securities writing is an art form, and Marty specializes in making sure you don't use words that are going to get you into trouble. Unique, best of class, guaranteed, whatever it may be, and that's the practical way of limiting it. You as the entrepreneur know your business, you know where it stands today, and an accurate description of what it is today versus what you hope it will be will also limit the problem, including proper risk factors, which is a combined effort between you and your attorney, is going to do that as well. And that's the way you limit exposure. I may have a different point of view than Keith does on this, but I've been doing this for 25 years. I represent lots of small entrepreneurial companies, including during the 2000 period where I had 50 dot-com companies that raised money from friends and family. Not one of them exists, or it probably existed 18 months afterwards, and there wasn't a lawsuit. It does happen, and when you're a regulator, you live with the bad examples of people really abusing the system. But by and large, if you do things responsibly, with responsible people, yeah, it can happen. I'm not going to give you a guarantee, but does it happen? Has it happened in my experience? No. And statistically, correct. And funding platforms are not going to get sued as much as everybody says they're going to, for a very similar reason. But there's the risk when you do investing or raising money from the public, you can get sued, period.
And one good thing is Doug mentioned, there are those caps on how much people can invest. So you have to, at some point as a plaintiff's attorney, really going to, I guess there's, the possibility of class action, but really going to look and say, wow, this person invested $500. I want to represent them so we can go get that and I can get my 50% of that.
One last thing, the reason you get sued is because you don't communicate with your investors post-funding. They don't know what's going on, and they wake up 18 months later to a zero, and that's annoying.
Let me ask a question from Twitter. Can issuers choose or deny investors?
Yeah.
I didn't know that. Okay. That was so unexpectedly short that I'm a little bit overwhelmed. Do you have one, Bryce?
What was the answer to
Yes.
that?
Yes.
Yes, okay.
See, you were also shocked that it was so short.
So do we have some more?
Further, depending on what the document says, most PPMs say that you have the right not to accept investments or subscription from anybody for any reason.
I would add, though, that as long as it's not for a discriminatory purpose. I mean, if you were discriminating against a certain protected class, you can't contract your way out of that.
And the follow-up to that is the crowd, as good as it is, if they like what you're doing, if they find out that you haven't done something, they can also turn on you very quickly.
Okay.
Okay, we have a question right here.
On forming the business entity, would you recommend a LLC, S corp, or corporation to work in this security environment?
With respect to this, it really doesn't matter what type of security. I mean, it doesn't matter your class. Obviously, the canned answer is that if you plan on bringing on VC money or going public someday, it might make sense to be a corporation. But honestly, I advise almost everybody to be an LLC out of the gates, and if you need to convert it on a VC round, we can do that.
Okay, here's another one we got. Can an issuer or current employee invest in their own Title III campaign?
An issuer or who?
Or an employee of the company invest in their own Title III campaign?
Yeah, it's the platform that has the conflicts of interest where they're not allowed to invest or pre-invest, but yeah, a company can.
Okay.
Do you have a question? Okay, question up front.
They have to disclose that.
Sure.
Are there restrictions for those who are doing self-directed IRAs or anything like that in this particular form of investment?
No, in fact, we were at this conference in Las Vegas, and there's self-directed IRA people that are circling saying, hey, come up, sign up with us because we'll help you invest in these crowdfunded offerings.
Okay. Oh, sure.
Oh, yeah, so no, yes, they can.
Okay, quick question. So I get it, as an investor, this is exciting and cool that I can do this crowdfunding thing. But as the owner of the company, why would I want to do an investor crowdfund and not a rewards crowdfund? Because if I get a successful rewards crowdfund, then usually the VCs are knocking at my door. It seems to be a lot easier to do a rewards crowdfund. Why would I do an investing crowdfund? That's the question.
I think it depends on your business, right? If you can do a Kickstarter, Indiegogo campaign, because you have a product, you have something that's cool, you have something that's going to appeal to millennials, you have whatever that criteria that tends to work. Yeah, absolutely. Why would you? Because you're not giving up any equity. It's a heck of a lot easier. If you have, but there are companies, sorry, I keep going back to this. The hearing aid company, what reward are they going to give, right? They can't do that type of campaign. I think, and there might be some disagreement here. If you go out and you raise a successful, crowdfunding Regulation CF round, and you gain this momentum from that, and there is that sort of ancillary benefit that comes from doing one of these. If you're able to go out and successfully raise, $500,000 from 500 different investors, that you've created a mass there. You've created something, especially if it's a consumer product. These people, you now not only have investors, you have customers. You have people that are going to believe. You have people that are going to be out promoting your deal. Say, hey, I own part of this company. I own part of this pizza chain. That's why we shop. That's why we buy here. So I think there is that incentive as well, even if it's not eligible for a Kickstarter campaign.
Well, and just to add on that, I mean, I agree with the panel members in that this opens the door for your friends and family to invest in a very clear, easy way, right? And there are a lot of companies where, before they can even run that Kickstarter campaign, whatever it might be, they need a little bit of money to get going. And this creates a mechanism for them to do that.
So let's use real numbers. I mean, VCs invest in about 5,000 companies a year. Angels invest in, I think it's 10x that, so call it 50,000. And there are many more interesting ideas when I travel across the country than that. So if you have the privilege of being of that class of deal that Peter's talking about, of course you wouldn't. It's anti-dilutive financing. Go take the money, and that's the end of the conversation. But if you do a $500,000 Indiegogo campaign, is that really going to attract VC money? I don't know. But you might want to, it may be enough to go with a Title III campaign as well. And you're going to see what we call hybrid investments going forward, whether it's Title III with a Kickstarter campaign or a joint Title III with a Title II campaign.
Okay, so we have time for about 2 more questions.
Great, I got a question.
And you're one.
Yep, don't have any friends and family. Trademark, it's on Golden Pond. So here's the question. I have a real estate investment trust, self-directed, in a skilled nursing facility. They have the benefit of the equity. They have also the added benefit of the need for the skilled facility. I'm selling them the opportunity to share in the profit potential of a skilled nursing facility, quite similar to an REIT. I want to sell it as a security. Can I do that and not be securities licensed to put that through the platform with my I disclose pro forma done all correctly? Is that too much?
I'm not sure I'm understanding the structural nuance that you're talking about, because are you actually a REIT?
A REIT is a security, so I'm not understanding the distinction.
The distinction is that I'm selling the REIT as an investment in a skilled nursing facility as a security that I'm selling. I'm the entrepreneur. I've got the building. I want to sell the building and the potential profit of the building through a security.
And so you're asking if you could do this through Regulation CF crowdfunding?
That's what I'm asking.
Yeah, I think the answer is yes.
It might not be a good candidate for Regulation CF just because you have $1 million cap, but there are REITs right now who are raising money they're crowdfunding right now through Regulation A people are raising money through another part of the Jobs Act, through Regulation A plus for REITs. So yeah.
Correct.
So was there one more question? Oh.
So someone who hasn't asked a question yet? Great, thank you.
Okay, so my question is as the entrepreneur doing this, what is the worst that could happen?
So I think we get that to Keith.
Yeah,
you're going to be talking to Keith.
There's a lot that could happen bad. I mean, from a practical standpoint, on a first blush, it's that you spend the money to do this and nobody signs up, and you don't raise the money. So you've wasted your time, your effort, and your money in putting it out there, and then there's no interest. But the other thing is, I think if you screw it up and don't do it right, you're exposing yourself to a lot of potential liability here, and not so much because the regulator is going to come after you, because if you're not intentionally committing some kind of fraud or hiding some real skeletons in the closet or something, it's not the regulator that you're going to have a problem with. It would be your investors. where you haven't done a good job with your paperwork, you haven't done a good job of communicating after the fact, and then when it goes south, you're sued by your investors, because now they've got a cause of action against you, and they can point to something that you didn't disclose, that you should have disclosed, or you weren't accurate in some representations that you made to the investors, and so you end up with a lawsuit on your hands. So I think those are the two big issues. One, that you waste your time and money and nobody comes to the party, and second, that you end up getting sued when the thing goes south because you didn't cover all your bases.
Or your mother may never talk to you again.
So for our last couple of minutes, I was hoping that each of you could give sort of the top 2 or 3 things that you think, specific to this audience of entrepreneurs, that you think are the most 2 or 3 important things to know and remember about Title III regulation. Yeah, I'm going to need to make that transition myself. Regulation crowdfunding. So everybody sort of knows what they're getting into, knows what they should worry about. Want to start?
Sure. So, and granted, I'm taking this from the perspective of a venture capitalist, right? That's probably pretty obvious across the panel. But if you're thinking like, look, someday I want to raise venture money, or I want to go that route, then, somebody had the question of, can I pick my investors, right? I think that's important. So every sophisticated entrepreneur that I know spends a lot of time thinking about who they allow to be an investor in their company. I think that's important. And I think generally kind of controlling this process. One of the things that we don't really talk a lot about in the venture community or about venture capitalists is that signaling is incredibly important, right? So we're making decisions based on limited information, and we have to make those decisions based on a lot of different signals and a lot of different information, lack of information. And so by controlling kind of this process, if that's the road you want to go down, think about like what you're going to be signaling, right? What kind of investors, how many you're going to have on your cap table, a lot of those issues. The flip side is, I think this is an incredibly interesting mechanism for getting a business off the ground when it's, pre-seed, and you can raise money from friends and family. And I think it's really interesting for businesses that fall outside of kind of traditional venture.
Ready?
So I think that there's a few takeaways here. One thing that's exciting to me, and why I've been a huge proponent of Jobs Act and the various provisions and tools that it's provided, it really just becomes another way for entrepreneurs to access capital. It's really, I've heard it called, the democratization of finance. We're allowing everybody to participate in these offerings. Now, the flip side of that is it's not if we build it, they'll come. I heard Devin or somebody referenced that earlier. It doesn't just mean, hey, we open up the crowd, we go through the steps, and man, people are just going to invest. Ultimately, crowdfunding, whether it's perks-based or equity-based, it's a marketing play. Now, if it's equity-based, that marketing is very restricted. There's lots of rules around that. Consult your securities attorney. But it is a marketing play. You've got to figure out how do we ultimately drive people, how do we get people viewing this so that they'll invest. So,
If you're not from New York, California, or Massachusetts, the likelihood of you raising institutional money is statistically unlikely. I agree with Peter. If you know who you are and you can raise institutional money, terrific, go that route. But I travel across the country to a lot of communities that don't know the right lawyers, that don't have access to Wall Street or Silicon Valley, who have really interesting business ideas, and they are worthy of raising money. And this is just one other available option as a way of doing it, and that's the message.
I'm the regulator, so I guess I'll say be careful. And I do think you need to be careful, whether you're on the entrepreneur side or the investor side. If you're the entrepreneur, which I think most of the audience here is, there are a variety of ways that you can raise money. And think carefully about who's really going to be attracted to your business and want to invest in your business. And if it really is just a small pool of friends and family that you're already connected to and have a good sense that they want to invest, frankly, there are cheaper and easier ways to do it. There are a variety of self-executing exemptions even. You know, if everybody's in one state and you're raising less than $1 million in Utah, as long as you don't do a general solicitation, you can raise up to $1 million from 15 people and not have to file anything, as long as you don't go out and advertise. You know, so think about all of those different options, maybe sit down with a good securities attorney who can guide you to the right process. And I am a believer that this may be the right process for some businesses, but make sure that that's you before you start down this road, or you're just going to end up hurting yourself.
And then I would just caution you, from a broker-dealer perspective, to educate yourself about this process. There is, like in any industry, people who are going to come in and want to help guide you through the process and going to want to charge you for that, and there's going to be a variety of things that can happen that educating yourself on crowdfunding and what specifically you need to do to make that work, looking at the finances of it to see if that works for what you're trying to do, I think are incredibly important and can make it a much better experience for the entrepreneur than if you end up going down the wrong path and taking all the money that you had planned to use for fundraising and then ending up with nothing. So on that note, on that happy note, I want to thank my motley crew of a panel here. You guys were great. Thank you to the audience. Thank you so much. This was the first time we tried Twitter questions, and I think it worked well. And thanks to Bryce for having us.
Thank you, everybody.